In this video, I will give a very quick update on Apple, Google, and the VIX. I will give analysis on the S&P 500 as well as the NASDAQ, and then I will review a few trade ideas for Amazon, Nvidia, and Procter & Gamble. This is the Apple daily chart. I'm just giving an update. I closed on my last video, which I believe was on Saturday or Sunday after this Friday candle here. I discussed how I would give this Apple short 2 more days. I did not. I closed it on this day because we gapped up in a big way back into or back above the lower warning line of this median line set, which I've discussed in prior videos. So I closed that for about a 90% loss. Combining that with the prior 60% loss is a loss of 150%. However, shorting Apple as a whole from over here when I first made videos about Apple, I still profited 250% to the downside because these shorts I closed ultimately for 400%. So 400% minus 150% still made 250% to the downside here in Apple. As I discussed, once this does bottom, we can use median lines to find a target for this bounce. That is this pivot low, this high, and this low, and you can see it's a standard median line set. This is the median line here. I would anticipate we will achieve this target, and then I'm actually expecting further downside. As I've mentioned in prior videos, we have this longer term pink cycle. We have already broken below a prior blue 2-month cycle low. We broke this low over here, which would suggest the remainder of the cycle should continue down into this longer term cycle trough. So we should make another new low. We should ultimately, or at least very likely, break this low during this final 2-month cycle of this longer term 6-month cycle trough. This is the Google daily chart. In my last video, I discussed a potential trade opportunity depending on the pullback we would get going into the FOMC. However, it did not continue to pull back. It actually, the very next day, because again, I made that video over the weekend after this Friday candle. So on Monday, it gapped up. Where did it gap up to? Let's zoom in here. It gapped up right to the median line, right to the target. And as I mentioned in that prior video, the upper warning line of this longer term median line set here would possibly act as resistance, and it did in a big way. We rejected from it. It does not mean we will not break above it and continue on up. That is certainly possible, but we initially found rejection, and that is a lesson going forward as to where you might want to take profits. Again, I did not actually take this trade. The setup did not present itself. As I mentioned in that video, it doesn't always give you a good entry setup, but the target and the first take profit both would have been excellent had this been a trade we could have gotten into. This is the VIX daily chart. As I mentioned in the last video, I was expecting us to kind of stay in here as we moved into a triangle from these 2 different trend lines. And I ultimately thought we would be breaking up in the future, heading towards somewhere around $20 as a good target. In fact, the opposite has happened. We have actually broken down, and because I am expecting further market upside, at least for a short period of time, I do think this will hold. I do think we will continue to slowly move down. I have put another key level here at 1244, about 1250. The next one down would be around 1050. And those are 2 places where we might potentially find some support or some stability before the VIX begins to move back up. I do still believe in the future, probably going into the next correction, we will ultimately break above this down sloping trend line. This is the S&P 500 E-mini futures chart, and as discussed in prior videos, I was expecting a correction into the 2-month cycle trough here. That correction never materialized in the way I expected. However, this trough did come in. It is very difficult to discern where it came in based on this chart alone. However, there are 2 very strong considerations that suggest it is right here on Friday, March 15th. First of all, that is pretty much right on time as far as this is, again, just an average of a little over 2 months, but it was 1 day late. The second consideration would be the clear return of bullish momentum. We had been slowing down ever since this big candle on Thursday, February 22nd. We had just been slowly grinding higher to sideways, and then we get a sudden return of bullish momentum. Yes, the FOMC was a catalyst, but the momentum had actually begun prior to that and does appear to be continuing. The other consideration, so I suppose there are three, I believe I said two a moment ago, would be from looking at the NASDAQ futures, which we will look at right now. I have shown in the past the chart of the Qs and the time cycles on there. They are mostly similar, but I have some more time cycles on here, and perhaps in a future video I will discuss the mint green and the darker green cycles here. So you'll notice I don't use them individually. I use them in conjunction with one another, but I'll use that for another video. But what we can see here is on the 2-week cycle trough, we did have a negative cycle. I've discussed this in prior videos for the E-mini futures chart, that the best way to confirm a longer term cycle is at least one negative cycle of a lower time frame. So here we have the 2-week cycle trough, followed by another 2-week cycle trough, which broke below where that cycle began. That is a negative trough, suggesting a higher time frame cycle trough, which in this case is the 2.5 month cycle trough. After that trough, just like on the E-mini futures chart, we have a sudden return of bullish momentum, likely confirming this longer term trough is in. We will know for sure this trough is in as soon as we take out this high, which as of right now, we have no reason to believe it is not going to take out that high. So because we would expect these to trough together, by these, I mean the NASDAQ and the S&P 500, we can pretty safely assume the bottom also came in for the 2-month cycle trough on the E-mini futures or on the S&P 500 on the same day of Friday, March 15th. We're back on the E-mini futures chart. Despite the trough coming in for the 2-month cycle, and despite the recent bullishness after putting in those troughs of 2 months, there is good reason to be cautious, as this is now the final 2-month cycle in a longer term 6-month, really it's closer to 7 months cycle. Typically in these longer cycles, we get more considerable corrections. Something else that would suggest limited upside, well, there are a few more things. Typically, when we have almost no correction during one of these cycles, we tend to get limited upside and a follow-up cycle that tends to be a left-hand translation, which means it will peak early and it will correct for more than half of the cycle. Now, it does not have to happen that way, but that does typically happen after a 2-month cycle with little to no correction. This first 2-month cycle in the longer-term pink cycle also had little to no correction. However, this did extend all the way to the end of the 2-month cycle before correcting. It is even more unlikely that after 2 back-to-back cycles like that, we will have a third cycle of the same nature. So, considering the longer-term correction expected coming in May or June, as well as the back-to-back extremely bullish cycles, we are very overdue for a more substantial correction, which I would expect sometime during this final 2-month cycle. The last reason I would expect that is something I have discussed in the last couple of videos. It has now been 132 days since we have tested the 50 SMA on the futures chart. The 2 other longest times since 2009 were 138 days and 153 days. If we were to go all the way to the end of this trough here, that would be a new record since 2009 and would be roughly 194, 195 days. So if we were to continue up and then correct to the 50 SMA, that does not mean we will necessarily find support there. We may initially find some support, but then we may continue to correct. And considering the lengths of time of 138 and 153 days, that might also suggest we may test the 50 SMA before this trough comes in, which would again make it very possible that while we may find short-term support, we may ultimately break below during this corrective cycle. Another reason I expect limited upside for this cycle is because we have a median line set. This is a standard median line set, yellow upper warning line, yellow lower warning line, and then of course red median line. We are approaching the upper warning line, at which point we are very likely to find good resistance, especially after such an overextended move. Now, that does not mean we will touch that and then immediately reverse. We can hit it, we can grind along it for quite some time. We can actually break above it and give it an overthrow before the correction begins. However, when or if we do in fact approach this upper warning line, that will give us an excellent trade opportunity where we can sell call spreads with a lot of time, anticipating that the market should at some point, even if it breaks above this warning line, should return down as it moves into the trough expected around late May, early June. So what we'll be looking for is as price approaches this upper warning line, or when it approaches this upper warning line, and let's just, for the sake of this example, assume it stays within this channel and we reach the upper warning line somewhere over here. You can follow this upper warning line up. If we are hitting the upper warning line, say around April 15th, that is just a random day. I'm not suggesting that's what's going to happen. You can follow this warning line up to the next expected trough of May 28th. And again, that is just an average. That's not exactly when it's going to be. It's just an estimate. And then you could sell a call spread at this level, 5,515. And if you do a 5 wides, then you'd be buying the other half at 5,520. So you'd be selling a call spread on this expiration date, and you will have selected this level based on the idea that this upper warning line should hold, or if it breaks, it should only be temporary before price begins to retrace into this expected trough zone. And you wouldn't only have to sell just one spread. You could go further out in time, a week out, 2 weeks out, another month out, however often you like to sell spreads, and continue to do that, again, using this upper warning line. And then as we approach that trough time zone, that would be a good time to close any of those spreads that you have sold, as again, after that price would likely return to the upside. I've zoomed back out for a moment. I just want to point out that these were not chosen at random. As I've discussed in prior videos, I like to select these pivot points based on the time cycle. So this is the prior pink cycle. This is the initial trough. This was the high, and then this was the low, or the low of the current pink cycle trough. And as you can see, this has been pretty well respected. We bumped up against the median line a bunch of times before breaking above it, retesting it once, retesting it twice, before continuing on up. So the expectation would be, since we have clearly respected the median line, we will probably respect the upper warning line as well. I'm back on the E-mini futures daily chart, and I just want to discuss short-term trade opportunities now that this 2-month cycle trough has come in. As far as for the SPY or the SPX itself, a lot of the move has already happened and is currently happening after hours. So I do not suggest any short-term trades if you have not already entered at the moment. I will be personally waiting until this 2-week cycle trough comes in before I trade the ETFs. However, with the continued upside, I don't want to just be completely sitting on the sidelines to the long side right now. So I will be looking at individual tickers. First, we'll take a look at the Amazon chart. This is the Amazon daily chart, and similar to the S&P, I have roughly 2-month cycles on here in blue. On this particular chart, I have a number of different median line sets, but there are just a couple that are important for this current trade setup. The first being the modified shift with the blue upper warning line, and you can see I have a quarter line in purple. The reason for that is it's essentially a sliding parallel where sometimes the upper warning line or lower warning line breaks or is not quite respected on the inside, and you can basically draw a parallel line of the upper or lower warning line or the median line and then kind of use that at the adjusted level. And that's essentially what we have going on here. So we can see on a lower time frame, we broke below this prior cycle's trough, just like we did on the Qs, and now we have put in a higher one, suggesting this 2-month cycle trough is in. We have already hit the target for this median line set. However, we have continued to respect, in this case, the sliding parallel, which gives us a good trading opportunity. If we zoom in a little bit here, and I will actually move to the 3-hour chart, we can see how well we are respecting this, again being the quarter line. We tested it, we bounced pretty hard, and then we came near it again, and a buying pressure came in with great force again. Because we have already satisfied this median line, and because now some time has passed since the trough, and the lower time frame cycles for Amazon are a bit inconsistent, I don't actually want to buy calls. What I want to do here is I want to use this lower warning line to sell puts. So I will do pretty much the opposite of what I suggested for the SPX with selling calls. I will follow this lower warning line up, and I will sell puts based on this lower warning line holding, and that price will be above it at some point in the future. Specifically, for this trade, I would be looking about a week out because we've just received some additional bullish pressure, and again, these cycles are a bit inconsistent. So I don't want to do anything too far out, and given the steepness of this median line set, I don't know how long it will necessarily hold, but I do know in the short term it does appear to be holding pretty well. So I'm going to go about a week out to next Friday, and I was looking at the 180, 177 and a half put spread to sell. And by doing so, assuming we open roughly where we closed yesterday being Thursday, that would have the upside for more than 100%. I would very likely close it before it expires, so I probably would not receive 100% if the trade does indeed work out, but I could still get something pretty close to that. And when selling puts, anything close to 100% is very good, as usually selling puts, you're taking in a credit of less than 100%, but these would be in the money with a pretty close expiration, so you can get a pretty good credit for selling those. This is the NVIDIA daily chart. I know this chart is extremely busy, and this does not have a negative cycle like we see on some of the other charts. However, considering the extreme bullishness of NVIDIA and the expected additional upside coming into the market in the ETFs, as well as many other tickers, it makes perfect sense for NVIDIA to be part of the reason why we are seeing that bullishness continue in the markets. So I want to find a way to get long in NVIDIA. And the way I'll do that is just like with Amazon, using a modified shift because of the steepness of this particular move and the minimal pullback, with the expectation that we're going to achieve this median line. And I think, in fact, it's very likely we will exceed it, but I'm not going to rely on it being exceeded. This might provide some resistance should we get back up to this level. So I want to set up a trade to where if we do get up there in the short term, I can still make a good profit. And so for this particular trade, I'm looking about 2 weeks out, buying a 925, 930 call spread. Should we achieve this median line, and ultimately I think this median line where we found resistance before, and should we be in that area around where these two intersect, one other thing you often find with median lines is that if you have intersecting median lines or median lines that intersect with other warning lines, that tends to be a point where price is attracted to. And so if we can be around here, around March 25th to March 28th, if NVIDIA opens at the current level tomorrow, or now today by the time you're watching this video, the 925, 930 spread would be worth about 100% of risk, giving potential 100% return on that trade idea. This is the daily chart of Procter & Gamble, and as you can see, it's a little difficult to tell on this particular time frame, but I have these pink cycles here, which are about a week long. They're actually very consistent, as are these longer cycles in orange here, which are about a month long. Additionally, we have this longer term pink cycle here. Now, while this last one came in early, which could suggest maybe this one, just for the average of this longer time frame here, could come in late around June, where we are kind of expecting a larger correction in the market. For now, this is placed over here based on this pretty deep correction here. If we are indeed going to have a longer term cycle correction during this next month-long cycle, that would suggest there's going to be some pretty good downside. And as I've mentioned in other videos, we can find that target by using the prior cycle high, current cycle, so this current pink cycle trough, and then the current cycle high. Now this is subject to change if we continue to push up, and as you'll see, the higher we go, the higher the target moves as well. For now, it is over here. I'm only doing this just to show how we will find that target. But if we are going to put in this correction early, or at least earlier than what is expected for the rest of the market, we have a pretty good target for that. So what I'll be looking for is a breakdown of these pink cycles. And what I mean is just a negative cycle where we break below where the cycle began. So as of right now, if we were to break below 160.33, that would suggest this negative cycle is telling us we're going to begin correcting for the remainder of this cycle, which currently lines up perfectly with the pink cycle and would suggest this median line is a good target. It does not have to happen that way. As I mentioned, this might actually end up extending, not that the trough of this is here, but because this one came in early, this one could come in late by roughly the same amount to maintain the average length of two of these cycles, which would essentially be one more of these orange cycles. That is definitely possible. So when considering a short trade, should these pink cycles start to break down, it's something we'll have to keep in mind. However, PG is one of my favorite stocks to trade because you can get incredibly cheap options on these, and the spreads can give you extremely good risk to reward ratios. So I'll be continuing to watch this going forward, and when we get closer or when a potential trade setup strikes, I will definitely discuss this again in future videos. As always, thank you for watching this video, and be sure to subscribe for more.